Welcome to the Dividend Talk podcast, episode 46 Small Cap Dividend Stocks with Russ. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you are new to this channel, please hit the like button and subscribe to us. And check out our previous episodes on YouTube and Spotify. See you on the inside. Good morning. I'm here today with Russ. Excited to have you. How are you, buddy?
I am good, and this is weird to be the only person on this without an accent.
and we're here with European DJI. How are you, man?
You brought us the bad weather from Ireland, right? Yes.
Hey, you two can see the smile on my face. I've been at the beach all morning. The sun is shining in this window. I'm happy, man. I'm so happy. But hey, excited to have you, Russ. This has been a long time coming. I know we've tried to schedule this for a long time, and it's early. It's early in the morning where you are. So thanks for taking the time to come on here.
Yeah, not too early, Funny.
So just for some of our listeners, can you just give us a brief introduction about maybe who you are and kind of what you do?
Yeah, so my name is Russ. I am 43. Yeah, next week, April 20th. My birthday's coming up, and I am from Chicago. Little joke there about my accent. Hi, guys. You want to go down to Clark and Addison, get some deep dish sausage pizza, go watch the Cubbies, have 2-3 brewskis. So, yeah, I'm from Chicago. Born and raised. I was in the Navy for a few years right out of high school. And I became a passionate dividend growth investor started getting the hang of it around 2018 after going through penny stocks and then swing trading. And here I am, just learning, improving. Don't know everything, but, if you want to run fast, you have to train with people that run faster than you. So that's what I've been trying to do. And love talking with you guys on Twitter, everybody on Twitter, everyone who's listening to this. If you're not, I also have a YouTube channel. Dapper Dividends is the name of it.
Yeah.
Family man too. I have a wife and 2 kids, so I don't want to leave them out.
Of course not.
Yeah.
I've been following your YouTube for quite a long time now, and you're doing a video every single day, aren't you? That's hard work.
Yeah, I have been. It's been a little crazy. So, but I'm thinking I might be coming to the end of that because the quality has suffered is in terms of quantity, trying to put more out. So, for instance, I've been working for a few days on a dividends in space little thing I'm going to do, going over 6 companies that are dividend focused that have some exposure to space exploration, space travel. So I think that's pretty cool. And I've been putting a little more work into it.
Yeah.
So I'd like to do that more. So yeah, it's learning. Yeah. As you know, I've been kind of going about it, throwing things against the wall, seeing what sticks. And yeah, so here I am. It's evolving just like all of us constantly.
Yeah. You've been working pretty hard, and I know we've exchanged in the past. You've had blogs, you've had podcasts and YouTube, but it's nice to see that it's starting to come together. And man, that one about space, my son will love that because he loves NASA. And I mean, when that drops, just let me know because that will definitely interest me in him.
Fantastic. I've been putting a little bit more work into it than usual, so it should be good.
Cool. So we're going to talk about small cap dividend stocks today. But before that, we usually talk a little bit about something in the news. And for me, something that jumped out was Coinbase. The IPO was this week. And I know that you are a little bit involved in the cryptocurrency. So I just wanted to get your thoughts maybe on this IPO and the valuation and a little bit about the price and market cap, etc.
Well, it's hard to put a valuation on something that has never traded before. That's pure play crypto. So it's really new territory. We don't know exactly where to value it. And the market, I think, is kind of finding that place that it wants to be at. and right now I think it's at like per share, it's what, 340 or something like that. I think it was last traded, but I was going to buy a share at 350 and it started at 380, went up past 400. I was going to, because I got excited, caught up in the FOMO. And then I started thinking about more of what I was reading, and they had $1.8 billion in revenue for Q1 21. Now that sounds great, but they didn't release any guidance, which makes me a little bit nervous, first off. And then secondly, there's competition coming. Schwab, Vanguard, Fidelity, they're all it's just a matter of time before they start offering cryptocurrencies that you can just buy in your brokerage account. So they're the first mover. And as the saying goes, the pioneers get the arrows and the settlers get the land. So just because you're a first mover, look at AOL, didn't work out all that well for them. So I don't know. It's a little bit rich for me. And I think if it goes below 200, I may just grab one as a what the heck. I don't gamble. So I know I just talked about buying some Dogecoin as it was blowing up. I put like $25 into it, USD, just to see what the heck. Maybe it goes to $1, $100. Maybe it goes nowhere. It's a complete gamble, which basically, in my mind, all the cryptocurrencies are gambling. We just don't know. There's so many out there. And how do you value them? How do you give a value to them? How do you assess them? So the way I've been doing it is the ones that have utility, that will have some real world function, like Stellar Lumens or Ripple, which will facilitate cross-border payments, and they're the ones that are disrupting the banking industry. Those are the companies that I think are going to just, for better or worse, do like the cars did to the horse and buggies. I think they're going to make them seriously think about what they're charging, the fees. I think I saw a number that $1 trillion a year is collected in revenue by the banks for their transaction fees. So, competition for them too is coming, which is great. What's the term? Creative destruction.
Yeah.
So for me though, I'm holding off for now on Coinbase, and I know I tweeted it out that I bought some Bitcoin instead, which I did. A little bit of Bitcoin, which I think is a good hedge because governments are printing too much money, and this just can't go on in perpetuity. So I think it's a good hedge. And I need a sip of old agua here.
You asked the question, how do you value a company like that? And I mean, we have nothing to compare it to. As you said, it's the first crypto-based broker to go mainstream. But then you compare to, say, Interactive Brokers, for example. Their market cap is currently 32 billion. And this is a fantastic company. I mean, it's been around a long time. I personally use them. And here Coinbase comes along and its market cap is 63 billion. Like, how has that worked twice as much as Interactive Brokers? It doesn't make sense to me. I personally don't use Coinbase. They're way too expensive. I use Binance or Bitstamp, which I find much better user-wise as well. But I scratch my head and think, how is a crypto exchange worth twice as much as an exchange that's been around for a long time?
How is Dogecoin worth what it's worth when it was created as a joke? It's all, and it's funny to say that, but it's all just supply and demand. If people want it, then it has value. And it doesn't matter. An asset is an asset, whether it's digital or physical. It's just, if people want the thing, just like gold, because people want it, I mean, yes, it has some utility, but it doesn't matter what it is. If people want the thing, then it's going to have value.
Have you any thoughts on this, European DJ?
No.
I was thinking you were a little bit quiet.
No, I've not my circle of competence. So
yeah, cool. Okay, I think that's all I have, unless you have anything else you want to talk about.
No, that's good. That's good.
Okay, good. So what we might do is we might move on to the rapid fire question round. So we will ask you 5 or 6 questions, 2 options, you give an answer, and then you can elaborate at the end on any 2 if you have anything to elaborate on. Okay? Don't worry, they're not too hard. Keep them nice and easy for you. So question 1, Chicago Bulls or Chicago Cubs?
Cubbies.
Oh, wow. Michael Jordan or Scott Pippen?
I'll go Scottie Pippen.
Okay, the Marines or the Navy?
Well, the Marines are a department of the Navy, so Navy all the way, baby. Haze gray and underway.
And AT&T or Intel?
I'm gonna go with my T.
Cool. And we know how you love to pronounce things, so European DJI has the last question for you.
Muniger Rijksversicherung or Koninklijke Ahold Delhaize?
Koninklijke Ahold Delhaize. Because I know how to say that one somewhat.
I watched your last YouTube video on Ahold, and I absolutely loved how you just kept saying the full name. It was just brilliant.
Well, my family thought I'd lost my mind walking around trying to get it just right. So yeah, I put work into that, boys.
Anything you would like to clarify more, your choice?
Oh, Scottie Pippen. I'm not really a big basketball fan, but back in the 1990s when the Bulls were just obviously a worldwide sensation, Jordan got all the love, and rightfully so. But Scottie Pippen, I think, was the underdog on that team, and he was just overshadowed by a living legend. So yeah, I don't know. I'll go with the underdog, with the guy that's fantastic, but never really got into the limelight because Jordan was there.
Yeah, it was really nice to see on Netflix the Last Dance as well, right? I don't know if you've seen it.
No, I probably should have, but I haven't watched it yet.
So if you like Scottie Pippen as well, you really need to watch it, because that's where you see the respect coming also from Michael Jordan. And it's also really interesting how his contract negotiations were going at the time. So I would definitely recommend watching that one. Really
I
great
will.
piece of history.
So we will move on then to the main topic, which is small cap dividends. So maybe if you just want to start and maybe talk us through what is a small cap dividend company.
Small Cap Dividend is a $300 million to $2 billion market cap company. That's the simple definition of it. And small caps have more growth potential, but they also have a lot higher risk, and they fall a lot harder when the market crashes. So there's a pretty nice risk reward balance with small cap stocks. And as we do, we invest for dividend growth. We invest for that passive income. So, yeah, I'd like to look at a few companies that maybe are considerable to put in your portfolio and to put on your watch list and think about investing in, to give that little bit of diversification across market caps.
Yeah, typically I tend to stay away from small caps because you mentioned they're a little bit more risky, and frequent listeners to the show will hear me talk about Tanger before, where I got burned. So I might have a little rant about them at some point. But there is some risks, isn't there, associated with small cap dividends compared to your large cap stocks?
Yeah, and honestly, I had invested in a few B&G Foods, ticker BGS, Invesco, ticker IVZ. I sold those because B&G didn't cut, but as soon as the market crash started happening, Invesco cut that dividend quick, and that just left a really bad taste in my mouth. So that gave me a little bit more experience that the big blue chips, this is why they're premium companies. This is why we're paying up. And unfortunately, most of them are at nosebleed valuations right now because I don't think a lot of people, and I mentioned this to you guys in private chat about ETFs, that Apple and Amazon and Google are the top three weightings of the S&P at 15%, I believe, right around there. So 15 cents of every dollar that people just blindly throw into ETFs are funneling their way into those companies. So it's just, unfortunately, well, good and bad, it's just blowing up the price of those companies.
So do you own any small cap dividend companies, or what would your criteria be to buy some if you don't?
Right. So off the top of my head, US traded ones, I don't believe that I still do. Obviously, I have mutual funds in my retirement accounts, the simple IRAs that are obviously invested in them. But in my dividend growth portfolio, my bridge portfolio, I don't. But looking for that yield, a steady yield, something that's not too egregious, something that isn't has an excessive payout ratio. And I like to look at free cash flow payout ratios. For me, cash is king. Earnings per share are accounting numbers, and that, as you guys know, can have all kinds of all kind of accounting gimmickry work baked into those. So I look for a low free cash flow, and if they've been increasing that dividend and they're generating cash. It's really hard for me to buy companies that don't make money. Those are obviously really speculative plays. So I would look for companies that just are generating cash and have good free cash flow, and their dividend is not, maybe not over 70% of free cash flow payout ratio for the smaller companies.
Do you also look into their dividend policies? Because what I've seen is that more the blue chip companies usually are really clear in the dividend policy about growing dividends, have the history behind them. Also, there are small cap stocks like that, I guess. But is this something that you put more weight on when you're looking at a small cap versus a blue chip?
I would, yes, because as we saw with Invesco, they cut quick. And when times are good, they pay it happily and raise it. But as soon as you start getting a little bit of headwinds, they cut. So I more look at their history and then just look to see what the company says about their dividend, if they're committed or they make any kind of a statement, is a good place to start. But obviously, like all things, when those what they call them, black turkey events, not the black swans. I was reading the black turkey, I think, since going back to 1871, that once every, oh my gosh, I think it was either 30 years or 8 years. Don't quote me on that. One of those two numbers, there is just a crazy thing that happens, and it sends the market into a tailspin.
Yeah. Well, I found a really nice exercise also today to look into small cap stocks, and I was surprised still about how many small cap stocks there actually exist with lots of years of dividend growth. And those are typically companies that have never been really acquired, lived on their own, under the radar a little bit, 5%, 6%, 7% growth every year, nicely humming along. And I was quite surprised about that, how many there actually are, because they don't really hit the news. You don't see them on FinTwit or something like that. So later when we talk a little bit about those stocks, it's also really interesting to see that.
So have you got any perspective on European stocks or anything across this side of the water?
I want more. I need more of them. Absolutely. I've been too much of a blind eye turned toward the European stocks, as it's very easy to fall into just investing in your, having that home country bias. At least for me here in the United States, it is. Obviously, most things are here, but yeah, I want more. I've recently started investing into Volkswagen, and then obviously Konica I've started investing in. And the only thing that I hate is paying the ADR fees, the American Depository Receipts. So banks, because they don't trade on the stock exchanges over here, so banks will buy the shares and then we buy them from the banks. Basically, they give us a receipt for the stock, and it'll be at a ratio. So Volkswagen is 1/10. Every share here of ticker VWAGY is 1/10 of a share of Volkswagen. So and you have to pay a fee for that when you get the dividend. So it's just something that, if people in the United States are not aware of, it affects it a little bit.
But it's interesting. So can you only buy ADRs, or can you buy a European company on their local exchange, like the London exchange or Madrid exchange, or does it have to be an ADR?
I don't know, because I buy through Charles Schwab, and okay, Charles Schwab only offers the ADR. And who I was looking at was British American Tobacco, ticker BTI. They pay a 5/1000th of a fee every time you get that dividend. So it's really small. It's largely insignificant, but other companies like, I believe, NEO, which is not a dividend company, I think it's a penny. I think it's a penny per share that you pay.
So, but to be fair, right, that many European brokers, you even still pay when you receive a dividend for the local native shares, or also when you want to reinvest. If those brokers have a chance, they take money left and right. It's also the maintenance fees that they're introducing. So that's what I've noticed as well. So there's compared to America, I think generally our costs are already higher, and then we have all the not the transaction costs that are directly there, but if you want to reclaim dividends, you need to do all the paperwork. You spend costs on that as well, on the fuel going to the local tax office to get the stamp on the form that you're indeed a tax-paying citizen before you can reclaim dividends from other country. It's I wish we had an ADR system here like that made our life easier.
Yeah, because it's typically cheaper, isn't it, for us to buy US stocks than European stocks?
Yeah,
considerably cheaper, which is probably strange for you to hear, but it costs less for me because I'm taxed the same. I pay the same tax on most countries because we have this double taxation treaty here in Ireland. So whether it's Madrid or the US, I pay the same tax, but I'll pay more in fees to buy a company on the Madrid exchange than the New York Stock Exchange.
I believe with Volkswagen, there's 3 fees on that. I believe there's the US fee, the bank fee, and then their local fee. So I think there was, and I did it in my Volkswagen video. I don't remember off the top of my head what it was, but I figured out what percentage of the dividend is coming off with fees. So I think it knocked it down below 2%. So their dividend yield was over, I don't know, 2.25%, we'll say something like that. But then after the fees, it knocked it down to under 2%. So it's just something to be aware of. But I still need that diversification. I'm trying to get a little bit more exposure to Europe, and Volkswagen is a good one.
And you might not only get fees, but maybe also fines with Volkswagen.
Yeah, that's kind of my sticking it in the eye of Tesla, because I think Volkswagen, they're really pushing hard from what I looked at to they want to be the EV company, which, we'll see what plays out. But I'm putting some money on that horse to see if they can get close to running with Tesla.
Okay, so what are then in general actually your favorite dividend companies, and why?
Well, how much time do we have? So, yeah, obviously, Pepsi has gotten up there as one of my favorites. For those of you who don't know, I've been buying 1 share a week, and I just bought number 40. Oh, God, I forgot. Number 43, I believe. 43 or 44. I'm losing track now. I'm getting older here. So I've been buying a share of Pepsi. I just love that they are so diverse between snacks and food, and most people don't know that more revenue comes from their food and their snacks than it does beverages, which to me is really strong. They have such a diverse lineup of food. When you really dig into it, it's surprising how many food brands that they do have under PepsiCo. And then companies like Prudential, I've been touting them for a long time. When the financial sector was just in a tailspin and disarray, it sucked down the insurance companies with them, which to me was a great buying opportunity. I bought Prudential and MetLife out of that. And even though somebody just asked me on Twitter if Prudential at $100 a share is overvalued, and I think it's probably fairly valued, but for somebody like me that was buying at $60 a share, it's such a mental block that I have to see something that's probably fairly valued, like AbbVie is another. I know we're getting off of small caps here, but AbbVie is probably pretty fairly valued at $105. But when I was buying it at $60, $70, $80 a share, it's so difficult for me to buy. Same thing with Lockheed Martin. I was buying them at $330 a share, and now they're $390, and it's probably really undervalued still. But it's just that thing I'm trying to overcome and grow and learn and get past, to say, hey, this thing is still undervalued, but yes, it's not dirt cheap, but it's still undervalued. So it probably makes sense to keep buying. And Prudential, big fan of the insurance companies. The banking sector, as we talked about, I'm worried. I had a few shares of Wells Fargo that I sold because I think that the disruption it's coming. They're knocking on the door, and the legacy banking is going to have to answer. And I don't know what's going to happen, but I would be nervous holding some of the maybe smaller bank stocks. I know JP Morgan and some of the other ones are going to, I don't know if they'll acquire some of the companies that are disrupting the industry, just buy them outright, which is, usually see that happen. When something's disruptive, well, either be taken over or just buy the steamroller and, So
what What is interesting around banks right now that you're saying, like then in fintech, and I had the same one when Ian Lopuk was here. I was just thinking, like, imagine how the pictures of the board of directors will look like 20, 30 years from now. There's just a whole generation of bankers being wiped out by fintech, like the suits with the ties are being replaced with the tech entrepreneurs, right? And I really wonder what it will do to this class of wealth and people that inherited the wealth from former bankers as well, right? It becomes a whole new kind of style of people in the financial system.
I don't know what's going to happen, but it makes it interesting every day to be alive. That's the whole fact that none of us know makes every day getting up and getting it's interesting for me to see. I look forward to every new day.
So you spoke about Pepsi, and I've been following you with Pepsi quite a bit, okay? And earlier in the show, you mentioned with small cap dividend stocks, you look at the free cash flow, you like a low free cash flow. Pepsi have a very high free cash flow, and it's one of my concerns. The free cash flow grows at a slow rate, and it's quite high with their dividend payment. So why the difference with Pepsi in terms of looking at free cash flow and a small cap dividend company?
Well, Pepsi's just a juggernaut, and I think they may not grow the dividend as quick, which to me is okay. If they reduce it to a snail's growth, I'm buying for that income. So as long as it paces with inflation, if they can keep that, then I'll be happy, which I think they'll do. And they're so big that I don't think they're going to do anything drastic. So, but we never know what's going to happen, and it's definitely a risk that I'm willing to take. So, I guess just their stability, their track record, their size, their history just gives me much more confidence than some of the smaller, small caps.
Okay, and if you were to sell a stock, what would be the reason then for you to sell a company?
Any company at all, or just a smaller one, or I guess any company at all. If their free cash flow payout is sustained, obviously there's one-off events, there's cyclicality that happens, but if they exceed 90% and they're not a REIT, if they're way up there, I know REITs are, it's apples and oranges, but if that free cash flow is getting way up there, and then another thing I love to look at is the interest coverage ratio, the ICR. If that starts dipping below 3, maybe like 1, 2, 3, then that would make me really nervous, because all debt's not created equal. So as long as they are able to pay the interest on the debt, which is what the ICR ratio tells us, then I would be okay holding. So those are kind of the two things. Again, to me, it just all comes back to free cash flow. It comes back to cash. If they can keep comfortably making the payments on the interest, and the dividend payout isn't an egregious amount of the free cash flow, then I'm going to keep holding.
Okay. And we might close out this section, so we might just maybe choose some small cap companies each and maybe explain. Have you got one that you would maybe recommend looking at? Just to note, it's not financial advice from any of us. It's just a recommendation of companies we like.
So B&G Foods, ticker BGS, is one that I like. $1.9 billion market cap, which plenty of room to grow. I think they're a little bit discounted because the industry PE ratio is 23.7 and they are currently at 14.6. So they're discounted there. The 1-year earnings growth is at 71%, which is awesome. Now the dividend yield is 6.32%, but it has been frozen for about 3.5 years. And one thing that's interesting is 78% of institutions own B&G Foods. So I love to look for high institutional ownership. Obviously, that's always subject to change. And they were founded in 1822. And one more thing, I can tie this into one of Ian Lopuk's favorite stocks, which is Hershey, ticker HSY. So B&G Foods, they tend to buy companies and they'll sometimes sell them. They bought Pirates Booty in 2013 for $195 million. And 5 years later, they sold it to Hershey for $420 million. So 5 years, they picked up $225 million. And that's what they do. They acquire brands and they'll sell them, they kind of flip. They're like house flippers, but for brands.
Nice. How about you, European DJ? Have you got Any small cap stocks?
Yeah, and probably what's good to mention, I referred to that earlier already, but in Europe, the UK is really big in small cap stocks and small cap dividend paying stocks. So one that I find particularly interesting is Chesnara. Chesnara is a life insurance and pension consolidator, and it has, how is it? It has, I believe, operations in the UK, Sweden, and the Netherlands. And they are located in Preston in the UK, so slightly north of Manchester. And what I really found interesting is that this company has been founded in 2004. It was a spin-off of Countrywide Estate Agency Group. And at that moment, they had a value of 126 million pounds or something like that. But since then, they have been every year, they've been acquired almost every year. So in 2005, 2009, 2010, 2013, they've been acquiring other companies, let's say. And that's also how they got into the Swedish market, into the Dutch market. And for instance, for people that might recognize those, so one of the companies they acquired and the brand they have is Waard Group here. And with that, they have been acquiring quite some policies. And yeah, I will touch base on that a little bit later. The company has a high yield. It has 7.8% dividend yield at the moment. It has been growing its dividend for 14 years in a row. The dividend growth over the last 5 years was slightly above 2%. And they have a price to earnings around 20 at the moment, and a market cap of 420 million euro, if you translate it in euro. And what I really like is also, if you go through the annual report, we should send them to P&G and all those poor investor relation websites, because their annual report reads really nicely. And it starts also with introducing themselves every year again, what they are. So that's really nice and appreciate. But then also they say, our primary focus is the efficient management of life insurance and pension policies. Of course, that's their business. But whilst generating profits to provide attractive dividends and value growth to our investors. And you see that all the way through the report, they're all the time touching back on their dividends and how, for instance, the earnings should be seen in light of the dividends. So I found this is like almost like the realty income for in their expressiveness when it comes to why they exist, and for them in their values, why they exist. It's also for paying dividends. 2020 was not a good year for them, to say so, because of COVID-19 and the restrictions. Other than that, they still increased the dividend with 3%. And what they are mentioning also in the report, that over the last 5 years, they've been paying out, they have been covering their dividends by 155%. Probably good for you to know from a diversification point of view. In the UK, they have funds under management around 2.3 billion. In Sweden, 3.7 billion. And the Netherlands, 2.5 billion. So it's not a local risk to a certain country. At least they are diversified over 3 countries. And they're pretty solvent, with a solvency ratio of 160% almost. So I found it a really interesting company, and actually it got me interested to do a full personal analysis on this, to see if I really have the courage to invest in such a company like this, because I like insurance companies in general. So, yeah.
Nice. So I went a slightly different route on this, because we all know I got burned with Tanger, and my risk tolerance with small cap stocks is not quite what I would like. So I chose an ETF, and specifically the Wisdom Tree Europe Small Cap Dividend Index, which is quite cool, because it features the bottom 25% of market capitalization of European companies, and they weight the companies then by the amount of annual cash dividends that are paid. And like you said, it's no surprise to see the UK being the highest region. I think that the UK is nearly 30% of this index. Norway, Sweden, and Italy then make up the top 4. I'm not too familiar with some of the companies, but in their top 10, they have CMC Markets, which I think we might know, and they have TGS NOPEC as well. I'm not aware of many other the companies there, but for someone like me, I would prefer to go this route than maybe picking an individual company. They have a nice yield. The yield's about 3%. Forward PE ratio is 20 at the moment, and that's pretty much it. I wouldn't be. I suppose my experience with Tanger was like Russ said earlier. When things went wrong, it went wrong pretty fast. I mean, they cut the dividend and they went from $16 down to $4 in a blink of an eye. Now I know they're back at reinstated dividend and it's back to 17, but I don't like taking that much risk, which is probably why I stick to large cap. And if I was to get involved in small caps, it would be through an ETF.
But that's interesting that you say that, right, about dividend cuts, because there were many blue chip companies that were in the, how you say it, in the blast zone during COVID-19. They also had to cut their dividends. Let's look at airlines, cruise lines, and you're talking here about the real estate, shopping malls. I believe it was Tanger, so I'm totally not surprised. But I see it rather as a company being in the blast zone than mentioning it's a blue chip or a small cap.
Yeah, but I feel some of the larger companies, we take Disney, for example, cut the dividend. I mean, there was not a harsh decline in the share price. In fact, it actually rose, where you see some of these smaller stocks, they will drop considerably faster, I think, than blue chip companies.
I still disagree with that, because Disney was introducing Disney Plus, and it was the perfect stay-at-home play for that. So it became suddenly one of the assets which was already under development. Suddenly became the hedge for Disney. If you see Disney as a thing, and you could argue maybe that blue chip companies, if they are more diversified and playing different markets, you might have this. But if I look at other companies, I didn't see an airline investing in how you say it, in other ways of travel or let's say leisure that how you say it, would benefit the stay-at-home economy.
Yeah, and I agree. And it's probably the same reason why I don't have too much exposure to those industries either. I mean, I don't have any airline, I don't have any cruise companies, for example, because they are higher risk at this moment. I suppose I'm aware of my risk tolerance, and I prefer slow and steady. I do have some gambles in Walgreens, Intel, but I think they're turnaround stories with proven track records. I feel they're safer than an airline or a cruise ship company or anything like that.
I'm with that.
Yeah, inside that blast zone, Realty Income increased their dividend, didn't they? They didn't cut. They just that's a solid company. I mean, I know you mentioned
Realty Income are a different case because their motto is the monthly dividend paying company. So I would imagine that if they were to cut, it would hurt them bad.
Yeah,
because that's why people invest in them, really, isn't it? Because it's that they promote that they're a monthly dividend company. You know you're going to get a dividend. It's going to raise every so often. If they were to cut that or suspend that for whatever reason, I would say it would hurt them bad.
Yeah, definitely.
Yeah. Okay, cool. Hey, that was a nice chat. Again, it's an area I wasn't comfortable with before, and it's nice to explore other avenues, and it's great that you chose this topic.
Well, it's overlooked too. It's by me. I really haven't focused on small caps in a while, and I was trying to think of something to talk about, and I don't know, it just popped in there that I don't. Nobody ever hardly talks about. That's not proper English. Hardly few people talk about small caps. They don't get much love. It's always the big blue chips, and probably with good reason as well. But there's definitely, the investing world is a really, really large place, and there's many different styles and different ways to go about it. And I think people should sometimes take a gander over at small caps. Probably do our due diligence by seeing what's in the small cap world as well.
Yeah, and we have quite a large community, so I'm sure some of the listeners will be more aware of companies that maybe we don't. So maybe drop us a comment when we publish this. Just let us know some companies that we might have overlooked. We'd love to look into them. Okay, will we move on to the listener questions? So the first question is always, and if you listen to this show, Russ, is always from Phil.
Mm-hmm.
And he has asked us, what is your biggest learning last year, and what would you do differently if you needed to start all over again?
My biggest learning that's really easy is that when the crash, the correction, the pullback happened, I was super comfortable. My portfolio went down quite a bit, but I kept buying the big blue chip companies that we were talking about. I was buying McDonald's, Starbucks, Johnson and Johnson. And as my portfolio value was going down, my dividend income kept going up. So I was just focusing on the dividend income, and my portfolio value, as other people were panicking, was really, really of second nature. And some of my friends were asking, "Are you panicking? Everything's going down. Are you selling?" And I was like, "Yeah, I'm panicking. I don't have enough money to keep buying." And they didn't understand it. They're like, "Why are you buying? Aren't you going to wait?" And I was like, "No, I don't know how long this sale is going to last." So I learned that I am extremely comfortable with downward volatility as long as it is the whole market and not obviously something core that's faltering with a particular company. But as a whole market selling off, obviously, for all we need for a bear market is for people to disappear, and for a bear market we just need people to reappear. And when people disappear and all our companies that we know and love and buy for that income start plummeting, I'm buying. So I was just cool. I didn't lose any sleep. The swan, slept well at night. It was wonderful. And if I was starting over, that's a tough one. If it's right now, because like I said, everything's at nosebleed valuations, I would probably just focus on the income, just buying that income from the Johnson and Johnsons, the Pepsis, the companies that are going to keep that solid and largely predictable dividend income coming in. I think shout out to, again, Ian Lopik. He says he's buying, he looks at that as a sunk cost, that he's just buying the income and he can never sell the shares. So I think that's a really, really clever way of looking at things.
Yeah, I have to agree with that. I mean, for me as a dividend growth investor, my goal is income. I don't even look at the price or the value of my portfolio on a daily, monthly basis. I just track the dividends, and surprisingly, it didn't trigger me as much when the price was dropping because I didn't pay too much attention to it. It's just more dividend safety. Will my companies cut the dividend or will they increase? And that's pretty much what I learned as well at that time, that I was comfortable with that once the companies kept the dividend. So no, that's great. It's good to hear that you have the same kind of learnings.
Plus one. Exactly the same. And last year was for me so much wealth creation for me. If I remember the spike in dividend income, it was really, really amazing. And I wish we could go back to those times. Of course, without the economic impact of many people losing their jobs, right? But for me as an individual, great times. But at the same time, I'm still learning so much. I still find mistakes in my investment strategy and such. Or, for instance, you mentioned about this earlier, Russ, about knowing what you paid in the past for it. It's something I'm really thinking a lot about lately, this price anchoring and the psychology of it. So what I did in January, I bought 3M, and that was for the first time that I was really having a feeling of averaging up, right? And it was really good for me to do that, because now I start looking at it different as well. I'm really trying to ignore the price charts and what I bought in the past, and purely look at my fair valuation. Is it at the price that I like owning it? Okay, let's do it. Because it drives me nuts otherwise, all the time looking for the cheap, hoping that it will crash again, and then just chasing and seeing it growing and lifting off and never look back again.
Well, the charts the charts don't tell you what to buy. They tell you when to buy or sell, and we don't want to sell. So the charts in that regard, you can look for, I guess, a little bit of a sale. And as what you said, to touch on that buying cheap stocks, we're looking to buy stocks cheap, right? Not cheap stocks.
And do you find your method of buying Pepsi helps? I mean, you buy, is it every week or every month without checking anything? You just buy. Does that help you?
Yeah, it's funny you say that. It really has, because I think I bought a few shares up around almost 150. And even this week on Thursday, it was around 141. And I thought I could maybe get it, wait, I'll buy it on Friday. It might be in the 139 maybe. And no, it went up a few bucks. So I had to pay a little bit more. But I'm committed to doing that. And the only drawback is it's going to become a bigger part of the portfolio, the percentage is going to be a little bit bigger. But I don't plan on selling them, so I think they're going to be around for quite some time. So it might be a little bit big for a while, but things are going to, I'm not going anywhere. This is going to be, hopefully, like I said, till death do us part. So, right. As investors, we don't want to look to, like in a marriage, divorce is last resort. So just because there's a little bit of trouble, all right, so we're getting divorced, so should be something really major and really big for me. Like the core foundation should be faltering, and there should be my fundamental thesis should be on shaky ground for buying that company. Then I would really start think of selling. So yeah, I'm looking to marry everything I buy in the my bridge account, because I'm planning on keeping that till pass down to my kids and grandkids someday.
Nice. Okay, we'll move on to question 2, which was an email from Mad Dog Barker. And basically he's saying that he has £500, so he's from the UK, each month. And he's just asking for advice on what we do. So should he invest in one company per month at the full amount, or should he invest heavily in his top 5 companies, adding smaller amounts every month?
Yeah, so that one's a little bit tougher. I know there's some popular wisdom out there that if you don't have a lot of money, that it's hard to properly diversify, that you should put it into total market ETFs. I don't know how much I agree with that. It's definitely a strategy. As for his case, I would, again, just buy something, build a nice foundation, something that's solid. It's largely predictable, and they're going to keep growing it. Obviously, we keep coming back to them for a reason. Companies like Johnson & Johnson, to me, are just a very, very solid foundation, and it would be very surprising if they started going south. So I would probably average across just the big safe companies like your Johnson & Johnsons and 3Ms, and I would start there.
Yeah, I believe he has a nice foundation. He has 15 companies, and then he has 5 in his top tier. And I wrote back to this email, and I suppose my advice on this was it depends on your fees. So investing a small amount of money, not small, it's relatively small, depending, it's still a large amount of money, but investing money like that, if your fees, for example, if I was to buy US stocks, it would cost me 50 cents for each company I buy. So it's not so bad. I could buy 5 companies, split it at 100 euro each. The fees are quite small. If I was to do that with European companies, I'm paying 450 per one. So you can see that it's 25 euros. So it's a big difference. So what I would do in that case, I would probably pick one company a month and put the whole amount in. It just depends on fees for me, really. I mean, there's no right or wrong answer. But I really want to keep my fees as low as possible. I mean, these brokers make enough money off me. I don't want to be a charity and give it to them at will either.
That's an interesting thing that you say there about that we can buy fractionals, because I was looking at some things, and they used to have to buy shares of hundreds, lots of 100 shares, back 30, 40 years ago. So this is completely new territory where people are able to buy thousands of a share. It's the complete reverse of how things used to be. So, I mean, imagine that if you wanted to buy a share of Apple, you'd have to save up $13,000 to be able to buy those shares. And that's just, that's the way it was.
Think about the shares of Berkshire. Yeah. Yeah, I have similar here, EMF. I would just buy one company a month. And I'm doing that actually now as well, right? I typically buy one company a month, and just for the simple fact that I want to study what I buy, and I only have so much bandwidth. So to split it up to 4 or something like that, I would need to even think about 4 companies I want to buy. So just from a time perspective, every month a different company, but in those foundational stocks, it will be my recommendation. And it helps really with the commissions and the fees here in Europe.
Cool. Okay, I have a question for you, European DJ, and it's based on a question we got on Broadcom a couple of episodes ago, where we said they were overvalued, and we gave the example that were 58 PE ratio. So Marcus asked us if we consider the forward PE ratio, which is currently around 18, and it's a lot lower than some of their competitors like AMD and Texas Instruments.
Well, let's say like that. I think he has a good point there, because there with the earnings, there's always a one-off here. But, and it's really about comparing apples to apples, because also the forward earnings, right? So I really prefer to look at the cash flow basis. And if you compare it to the competitors, I think the chip industry generally is really expensive. So from that point of view, I'm not investing even in chip, because if there's one company I would like to own in the chip industry, it's ASML. That's the one I would love to own. So from that point of view, I think the whole sector is overvalued, and otherwise you end up with a company like Intel, which is a broken company in their fundamentals at the moment, in my opinion. So yeah, good point around the forward PE. It is something to look at, but I rather look at the cash flows in this regard. And Broadcom doesn't look too bad compared to the competitors, indeed. So.
Yeah, and there's also that psychology. I believe I don't know their exact price, but they're up over 400, aren't they? €400 or $400 to buy one.
Mm-hmm.
It's probably hard for me, probably, to buy a company like that, because I can only buy maybe 2-3 shares of them at a time, and I'd like to own more.
Yeah, I don't have that issue itself. To be honest, because in the end, money is money, and dividend. I look at absolute dividend income. So, well, but I do like Broadcom as a company. I think it is a well managed company as such.
Cool. Okay, Russ. Dividend Wave has asked you, what are your ride and die stocks?
3M, Johnson & Johnson, Pepsi. That would probably be it. I mean, it's hard, because it's like you just asked me to choose my favorite children. It's so you can't do that. But if you had to ask me the Warren Buffett question, if you had to pick something and the market was closed for 10 years, I would say 3M, Pepsi, Johnson & Johnson would be my choices. Easy ones.
European DJI, who would you pick?
Yeah, I'm just interested that you didn't mention any tech or something like that, technology-related stocks.
It changes too quickly. Microsoft, you could make a very good case. They're getting a lot of government contracts, so they are going to be favored in that way. But tech just rapidly changes so quickly. I'd be very nervous holding for a decade. Just think of 10 years ago where we were with tech. How much has changed since 2011? It's been incredible.
Yeah. So my ride or die stocks EMF would be Microsoft, definitely, Johnson & Johnson, and Unilever, I would say.
Yeah, mine is quite similar. Microsoft, Johnson & Johnson, possibly Unilever there. Sweet. Okay, Tommy has asked us, how do you at times like these, when all stocks are so expensive, invest in stocks, I imagine?
Not all stocks are so expensive. I just bought this was last Friday, Bristol Myers. Yeah, it's not expensive. I think it's harder to find stocks that are fairly valued. So it starts to become more and more like trying to find a needle in a haystack. Yeah, sometimes that feeling. But I mainly have this feeling because I don't want to add to companies that I'm already having a lot in my portfolio. Yeah. So, but other than that, I mean, I could, if I wouldn't have so much Unilever, I could buy Unilever any day. Koninklijke Ahold. I said Bristol Myers, AbbVie. There are quite some, probably like 10 stocks out there that I could easily buy if I would start over again. Even AT&T, I would consider initiating a position in there.
Yeah, I just bought Gilead Sciences. I did a video on them, ticker GILD. I think they're being mispriced right now. They've just acquired 3 companies over the last year, and I think they're gonna do really great things. So you're right. You just have to look a little bit harder. And we're not as lucky as when the crash happened and you could just buy anything and it was on sale, which is why we're longing for those days. I can tell.
Yeah, exactly.
I think there's more opportunity in Europe at the moment than US companies. I think we're slightly less overvalued. I know we've reached some highs as well, but companies like Unilever, Danone are massively undervalued. You have Bayer, you have Ahold. I'm not going to pronounce it like you two do, but I think there's a lot more opportunity for us over here in terms of valuations. So that's just my thoughts.
Yeah.
Okay. ESET has asked us, has your political views changed since you became an investor? So his views he considers voting differently.
That's a really interesting question. Here in the United States, I was raised in I guess what this probably might not make sense to you, a Republican household, which is on the right. And as I went into the Navy, I really started to gravitate more toward the center, which is where I'm at right now. So I don't like to pick political parties. I know we usually don't talk politics in the finance world, but you have to pay attention because there's talk now here in the United States with Elizabeth Warren and the Bernie Sanders with the wealth tax, and they want to raise taxes on dividends, and so you have to pay attention. So, yeah, I guess it does change you as an investor because it's not this whole of attacking the rich type mentality, and obviously I'm investing to become wealthy. Not looking like the monopoly guy, the greedy wealthy people, but I want to make sure that we have enough money to be comfortable. And I don't understand why some people frown upon that, why that's a bad thing to delay gratification, to work, to save, to educate yourself, to invest, and to try to make sure that your posterity leaving a good financial legacy behind. So yeah, if somebody wants to take more of my money just because that I have more, then I'm not okay with that. I'm all, so it's could sound cold. I'm all for social programs if we can pay for them, and I do believe in helping people out that are truly unfortunate in situations.
It's an interesting question from an Irish perspective because politically we have no impact on any of this stuff. We're too small of a country within Europe, within the world, but we do as investors have to keep an eye on what's happening in America, which is strange. I probably know more about the American system than the Irish system sometimes, but I mean, I have no votes over there. I can't influence anything, but we have to be aware of what's happening because it can affect us. Here in Europe, we have something similar within the European bloc, but who I vote for politically in Ireland does not change that. It's more of a European-wide thing. So it doesn't change my views politically. And like you said, I kind of keep that separate, but I have to keep an eye on what's happening on your side of the water. So I'm prepared what happens to companies in my portfolio.
Yeah, unfortunately, I gave up. I see a lot of people fighting, especially at this last election cycle, and it's always going to happen. It's just is what it is about politics. But I've tried to focus more on my family and myself and not worrying about the government because I think it's just to the point where, this could offend people. I don't think it makes a difference who we vote for. I think it's just going in the same direction, just one party is running and the other party is walking behind them. So, yeah, I'm just trying to create as much wealth for my family as I can because wealth gives us options. And I want to have as many options as possible. And not saying that I would leave the United States, but obviously I've traveled, I've been around, I've seen Australia is awesome, and there's a digital nomads. There's, we see these people on Twitter that live in Thailand, or they're expats from Europe or England or the United States, and they live in other countries that are a little more favorable to their style. So anyway, just I think we create wealth because it gives us options.
Cool. Okay, and the last question is probably the most important question of the day, is from the Wolf of Hardcore Street, and he wants to know, when are you coming over to Ireland for a real pint of Guinness?
I am looking forward to it. We have plans for no date exact, so hopefully the hopefully travel is open back up, and we will be coming in the summer, maybe July, August of next year. So I think we're going to try and do maybe 8 to 10 days, something like that, make it worth our while, and spend half the time between Ireland, and then we want to see England, we want to see London, that area. So yeah, I can't wait, man. That's the top of my list. I told my kids, number one, the Guinness factory. We're going to go to Daddy's Willy Wonka Palace. So and my daughters want to stay in the hotel room. So okay.
Yeah, I have to say the Guinness there is amazing. It's the nicest I've ever had, and even some of the pubs around that area, obviously they get it straight from the factory. It's highly recommended for me.
I love it.
Thank you, Russ, really for joining. It was really a pleasure.
Wait. I have a question for each of you. I love to know different cultures and different people. So to each of you, if you knew you would have one last meal, you could have anything you want at all, what would your last meal be?
Mine is easy. I love Italian food. I would just have, probably for starters, I'd have minestrone soup, and followed by lasagna. And they'd be my two favorite.
Really?
Oh, I'm not a foodie. I would probably skip it. It would be a waste of time, knowing that I've got no time left. I would probably do other stuff that I would like to do more there. But if I really had to choose a meal, it would be some Thai food. I would definitely go for tom yum kai soup, something like really spicy, something like that, and a nice curry. Yeah.
Really? Mine would be deep dish pizza, Chicago style, and some brewskis, some beer.
Nice brewskis. Hey, we
Fun
forgot
question,
brewskis.
guys. Yeah, fun question.
Hey, it's been a pleasure. Loved having you on the show. We've been communicating for a long time, and we tried to make this work. And we do appreciate you getting up so early to chat to us. It's been.
I was up
great.
already. I'm just usually not talking to people halfway around the world.
So I hope you enjoyed it. And I know you like words and learning. So I'm going to say in Irish, I'm going to say Gorev Matagut as Chocht Eran Show.
I'll listen back to that. I love it.
It basically means thank you for coming on the show.
You're welcome.
Gart geluach.
That's also European DJI's version of Irish, and I'll let you look that one up. So, as I said, been a pleasure. Again, European DJI, thank you for coming here Saturday. I know it's Saturday afternoon, so appreciate your time. And to all our listeners, thank you. And if you haven't already, please subscribe to us, drop us any comments or questions, and we'll see you in the next show.